The session is entitled Regulatory Catch-Up, Understanding Changing Regimes. Our moderator today is Sophie Gerber, co-CEO and Director of Traction Fintech, and Sophie Grace. Our panelists will introduce themselves in a moment, though I'll first give them a brief introduction. We have here today Ron Finberg, Director of Global Regulatory Reporting Solutions at IHS Markit, Jude Bahnan, Managing Director at Trading Compliance, Rennie, Managing Director and Co-Founder of Kaizen Reporting, and Constantinos Constantinides, Director at Comply. Let's give them a warm welcome. Thank you.
Thank you.
Hi, everyone. Oh, it's on, definitely. Okay, so everyone's been introduced, so we're not going to waste any time with introductions or self-introductions. We're going to go straight into it. So we're here really to talk about regulations, primarily European-based as it pertains to Forex brokers. So going to ask hopefully some hard-hitting questions at the beginning, and then we'll take questions at the end. Okay, so first is really directed at the British people on the far left there. Well, there's lots of British people here, Constantinos as well. Tell us more about what you're thinking or seeing as the future for the FCA's direction as opposed to ESMA, Jude or Ian.
I'm happy to pick that one up. Hi, Sophie. Thank you. I think, obviously, the UK left the EU, and part of that was to gain its autonomy, to be able to take over the rule-making process and the decision-making process at government level. As far as the FCA is concerned, I think what they did was, in terms of legal process, was they put in place some legislation and basically sucked in all of the existing EU legislation into the UK. So that's all set and settled. I think going forwards in terms of divergence, I think that was one of the main questions is, how far could the UK start to diverge from EU regulation and what are the challenges that pose? So far we haven't seen very much. I think that FCA has taken a few small steps. We've seen some very small changes around reporting that I think you would probably know more about than I do. And I think we've certainly seen there's some new prudential rules coming into force, which already the UK has decided to adopt them, but in the EU they came into force in the summer. The UK decided to delay for 6 months. I don't think the UK can afford to diverge too far from the EU. I think that's the fundamental question: is how far can the UK? Is the UK going to set itself up as a kind of low-cost destination or slightly, lower barriers to entry? And I don't think it can afford to go too far away from the EU because there was no trade deal done on financial services, which I think, is something that really disappointed me. I didn't want to leave the EU. And I think the fact that we neglected to or were unable to fix a trade deal with the EU was a huge omission. We spent a lot of time arguing about fish. Probably should have spent a little bit more time discussing financial services. So I think we actually potentially have given away the crown jewels, which is, a lot of the financial services. We're a mass exporter of that. But that's a personal opinion. There's still a hope that the UK will be able to reach what we call an equivalence decision with the EU, where the EU will deem the UK to be an equivalent jurisdiction and following equivalent standards. And that's really the main reason why I don't think the UK can afford to stray too far away from the EU.
Ian, your thoughts?
Yeah, thanks. Agree with a lot of those. Looking at it from a more specific area around trade and transaction reporting, which is what we do, is the real test will come post the EMEA refit and the consultations that are ongoing at the moment. There are separate consultations, but from our experiences, whether we're speaking to the Brexit entity that's been set up, so the European entity or the UK entity, the clients that we have, which range from the large to the small, they will be responding with a consistent message, and that message will be as little divergence as possible. Now, whether that consultation is listened to, we expect that it will be, and divergence will be kept to a minimum. And I think the noises that we're hearing either from regulators or trade associations who are closer to the detail, all the noise is about limited diversion. So the FCA, only a few weeks ago in a webinar, were talking about wanting to keep divergence to a minimum as possible. ISDAs were giving out a similar message only last week. So yeah, the expectation is that the divergence, at least around the reg reporting requirements, will be kept to a minimum. And we would expect that to be the case. But the litmus test will be come the EMEA refit and what the final papers are going to be on that.
Okay. And then, so Constantinos, you're doing licensing out of Cyprus as your base. What are you saying to people in terms of their licensing requirements or what they should do as their strategy, UKA versus ISEC and island jurisdictions? What's your standard sort of line?
I think it really comes down to sort of target market. The UK still has in place, similar to the EU, sort of the equivalency that's coming in and the overseas persons exemption, whereby for equivalent jurisdictions you can still provide services on a sort of reverse solicitation style basis. So it really is starting to look at, okay, do I want to be marketing and soliciting in the UK if I'm in the EU? And then if so, okay, what steps do I need to take to do that? Because now you'll need substance, you'll need presence in the UK. Whereas the UK brokers looking to market and solicit in the EU, it's the same vice versa. You have the reverse solicitation principle in place, and with SISEC you require legal opinions in order to be able to do that sort of side of things. So it really comes down to a business decision on how much exposure you want in either jurisdiction, the UK or the EU, to be able to understand what the right fit is for you.
And then in terms of an island jurisdiction, is SISEC saying something about that? I saw that FCA certainly was recently.
Yeah, so was quite lucky to be, to be involved in a couple of FCA reviews with a couple of SISEC brokers when they were questioning their entrance into the TPR, whereby they were looking at certain aggressive style brokers with call centres and so on. And we are seeing a big push from both SISEC. You can see a number of suspensions which have come out to those brokers with a heavy reliance on their offshore regulation and trying to ensure that they're sort of taming them, if you like. They're trying to have an overreaching arm to bring those underneath the SISEC or the UK equivalent. That's what we're saying.
And Jude, are you saying something similar, or what's your perspective?
Yeah, I completely agree with Constantinos. I think, again, going back to the Brexit scenario, the UK, part of the crown jewels it passed away was the right to passport services freely into the EU, so potentially losing a market of 27 countries. So people ask me, should I set up in the UK? Should I set up in Cyprus? Where should I establish myself? And I think to be frank, the UK and Cyprus are probably the main two jurisdictions that remain CFD friendly. Possible exception of BaFin, Germany. So the question is really simple in that where is your target market? It's exactly as Constantinos said. If you want to target UK investors, you have very limited exemption, which is the overseas person exemption, which is this concept of reverse solicitation, which is where the client finds you. You don't find the client. If you engage in any form of marketing now as a UK firm in the EU, you're potentially going to get in trouble with the local regulator. You can't just market freely. You can't just post up your French language and Spanish language and your general generally marketing is prohibited. So the question is, do you want to have clients in the UK? You're going to need to get UK authorised. And you referred to the TPR, the temporary permissions regime. So the UK kind of handed out this olive branch, I think, to the EU, hoping it would be reciprocated. And they said, well, you know, if you're doing business in the UK as an EU broker, we'll give you this temporary permission and you can keep doing your business. It wasn't reciprocated by the EU. And there's a lot of firms have come into that temporary permissions regime. Now they're being asked, they're being given landing slots. They basically have to step up to the plate with a full authorization pack and explain how they're going to do their business, who's going to be there, what capital levels. And I know, because I sit on the FCA, on a committee with the FCA authorizations, they're going to be very strict about that. They're not just going to let anybody through. Island jurisdictions?
Yeah, talk about that.
Island jurisdictions, yeah, I mean, nobody likes them. The FCA doesn't like it. They don't want to see business offshored. They certainly don't want to see UK clients offshored, and if they become aware of it, they'll take steps to act against it.
Can I just add? I think the only time where I would look at a combination of the two with the FCA and SISEC, SISEC is not such high regard with the payment institutions and the credit institutions. So if you are looking for gravitas of the FCA, it does help with your sort of payment solutions and banking. So that would be the only reason I would recommend both. Excuse me.
So Ron, you're dealing with a lot of firms who are doing reporting maybe in one or both. What are you seeing? What are the themes and issues coming up?
Thanks. So I think it's been, we see a lot of the different volumes that are taking place. It's a little more difficult to be able to attribute flows changing because of regulation, because we had 2020 was a monster year for all brokers, and there was a lot of volatility, and now we're seeing like a reduction of that. So more likely than not, that's just a result of the market kind of the froth going away. But I think in terms of our clientele, there's definitely a push to have both the UK and Cyprus or another European license, and the pushback from Cyprus recently about giving a lot of warnings of companies that they're marketing to they're marketing to UK clients has definitely put a little bit of a worry into different firms. So what Constantinos is saying, have the license into where you want to market to has become top of a matter for most firms.
And so in terms of the data that you're getting, are you seeing regulators starting to look at that and approaching clients? I mean, it's a really question for you and Ian with what you do. Are you getting noise back from regulators from that data?
Yeah, so there's been a lot. I think it goes back to 2017. Before Brexit, ESMA did a huge EMIR review of all the different data, and then they took their findings, showed it to the different regulators, NCAs, and slowly but surely the NCAs have been going, one at a time, approaching different brokers. So this is about a 3-4 year process. And one of the bigger problems that we've actually seen, and this is something that as a company we've raised this to ESMA and in the different consultation papers, is that we found that there's actually a divergence between the interpretation of EMIR between the different NCAs. So I don't want to call out specific ones, but there's one NCA they'll say how notional amounts should be written compared to another one, and then so we'll have clients are saying, okay, they'll be freaking out. It's like, oh, they're saying we have 10 million trades we have to take care of, and and there's all sorts of different problems, and one little change of a minus or plus, send the regulator, and then everything's fine. So I think that's a bigger problem that ideally the ESMA should be having more of those conversations with the NCAs to kind of make sure that there's more standardization in the interpretation between the NCAs. Obviously, it's a very difficult endeavor because there's thousands and thousands of pages to be making sure everybody's standardizing, but that is probably the biggest issue we have is not that the regulators are looking at it, but they're looking at it in a way that might not be, they may be looking at it incorrect.
What's your thoughts?
Yeah, I mean, if we look at it from a macro point of view and take a kind of a step back, For those, and I'm sure there are a number in the room that have been involved in reporting since MiFID I and all through the financial crises, the excuse that regulators gave when you try and answer the question the Queen raised is, why did nobody see this coming? Regulators said, well, we didn't have the data. We weren't asking for the data. You didn't give us permission to get the data. And we're now like a decade on from the G20 Pittsburgh, or more than a decade on. And that excuse isn't there anymore. So when regulators say data quality is their first, second, and third priority, they really mean it. They mean it because it's the right thing to do. It helps them do their work. But they also mean it because they've got skin in the game now. Because when the next crisis comes, in whatever form it is, the data's there. The fact that they haven't been able to do anything with it, that's not the industry's fault. Apart from it is. Because if we don't get the data correct and in a correct format to them, then they will come back to us. So I think the direction of travel, whether it's here or in the States or in APAC, is that we will see regulators having a tougher line with firms. And I think then if we go back to the kind of the micro level and look at it from a regulatory specific area, they do have the means available to do more detection. So if you look at MiFID, for example, all trades done on a trading venue has a unique trading venue ID. Even the smallest regulators with the limited budgets can take that ID, do a simple reconciliation. They don't know who's wrong, but there'll be differences there. So they've got mechanisms to do that. And then in EMEA, we've always had pairing and matching by dual-sided reports, mixed quality. But they have the mechanisms to do that, and they have the will to do it. And I think just finally, so I think that all leads up to, will there be more public censure and fines going forward? I think the short answer to that is yes. But also there's a kind of a fining regime in place for some of these regimes already. So if you look at MiFID, for example, when they included the line that all records with errors have to be re-reported, that is an administrative fine. So we reckon under our analysis, there are more records that have been re-reported than were reported in the first instance. And that's a really heavy burden. And Ron, I'm sure you see the volumes coming through on the replays to back that up as well. So,
Yeah, definitely.
And so I guess we saw recently a fine from ESMA against Univista, and you do see that there seems to be technical problems with some of the trade repositories. They're not the first trade repository to get a fine. What do you say to your clients do they talk to you about that? Do they get concerned about which trade repository they're going to?
I think firms, as long as they know it wasn't their fault, are kind of, they think like that. I think there was questions about whether the Univista fine was a political fine. We don't think it was. I think it's if you think about the process of fining a trade repository, it goes over a long period of time. It was probably started pre-Brexit in many ways, those investigations. So yeah, but there is a double-edged sword when it comes to trade repositories, because the harder you make it to become a trade repository, the fewer firms that want to be trade repositories are. So whether that will be a factor on whether regulators fine trade repositories is something to consider. But I certainly think for the end firms that we will see a tightening of the screws. Yeah.
Sophie, what you mentioned about what companies are worried about when they see a fine, I think the optics for Univista were pretty poor, because they not only had the fine, the amount wasn't that big compared to other fines, but it was, and then following right after that, then they closed their SFTR trade repository. So it did lead to quite a lot of companies going out, and saying, and then CME last year, do we have to start worried about, Univista closing or Regis or even DTCC changing things? So that has been something in the market that that I think the worry is less about, if a trade repository gets fined, but they're worried more about things closing down. And that is something that I think ESMA didn't, they weren't really thinking about it, but now that we've had two in the past 2 years, they're definitely, it's on the top of their mind, like, how do we make sure this doesn't happen?
And so over the time that you've been in the trade reporting space, going back to, you see a lot of people with UK and SISEC, are you seeing a broad theme that people are picking up licenses outside of the EU licenses? Is it more becoming the standard to have 2 or 3 licenses? Or
I think in terms of what we see, because we see the flow of how things are reported, there's definitely this SDP to SDP to SDP, and then you have that final, it could be UK, it could be outside, an island type of regime that's actually warehousing it. And I think for accounting reasons, it's really both ways. I've seen island companies, SDP, even though that's their main jurisdiction, sending it back to their UK as the one that's warehousing it. A lot of it just has to do with with banking relationships. If your UK entity is able to have that banking relationship, then you make them the principal that's taking all the risk. If you're able to do it in other areas, then you might do it in other areas because you're able to reduce your capital allotment. And Jude and Constantinides know more about that. What do we call it? The regulatory arbitrage. So, yeah. So.
right, okay. Go ahead, Jude.
Yeah, I was just going to say it's exactly that. So, I'm seeing a lot of clients, a lot of CFD providers. They've got SISEC license that gives them access to Europe. They've got their UK license, which could be legacy, but I'm still seeing an influx of people wanting to get authorised in the UK. I think the FCA is still perceived as gold standard. It is still the centre of FX, Brexit or otherwise. It's got, the deepest liquidity pools. There's a lot of reasons to be in the UK. I think what I'm seeing is the cost of being in the UK is increased significantly. Gone are the days when you could just get a little serviced office down the road, a couple of guys in there, 125k limited life firm, put a 200,000 capital. Those days are gone, And the FCA are drilling harder and harder into new applicants. The new financial rules come into play at the end of the year, and match principal firms are going to cease to exist. If you've got a dealing as principal license, you are a 750, and it's not euros, it's sterling. And that's when you go out of business. So you've got to walk in with 2-3 million in your pocket, and then your risk book. So, yeah.
Wow, okay. So, Constantinos, what are you seeing? Are you seeing a similar trend in SISEC, and what else takes up your time?
So, from the regulatory standpoint, what we're also seeing is a big cost-benefit analysis coming down, and part of that comes on transaction reporting as well. So we're seeing a lot of people move to jurisdictions that are equivalent, that don't have your sort of reporting obligations coming in. Places like the DFSA in the UAE. So seeing that going to explode over the next couple of years once people start to realise that actually we can send all our risk over to Dubai. There's no reporting obligations over there. So there's a whole cost-cutting side there. But then that goes back to the gravitas of having an FCA or an EU license. Is Dubai really seen as equivalent? That's one of the major things we're seeing at the moment, just a real big cost-benefit analysis. And then from a other point of view is moving away from the sort of call centre culture that SISEC and the FCA are really cracking down on, and going to a more gamification style thing.
So call centres, they're happy for them to be in the EU but not outside, or what's the view?
So with the call centres now, it's generally look to try and get them regulated. So you're looking at, okay, you have a call centre, you need to go and be for the FCA, you'd be an authorised representative, or in the EU, you'd be looking at becoming a tied agent. And then all of a sudden, those call centres come under regulation, and they start to be monitored, and compliance officers have a lot more workload to be doing, monitoring phone calls, marketing, etc. Yeah.
And so, Ian, what's taking up your time with what you do with the reporting?
It's I guess it's our clients' time. Am I on? Yeah, I'm on. So I think from our client's perspective, the regulation, as we all know, is continuously changing. So we cover the global regulation sphere, as I know you guys do as well. We have CFTC rewrite coming, maybe not coming, SEC. We've had MAS rewrite. We've got EMEA refit. I'm already hearing rumours of MiFIR 3, which a lot of us hoped would have been retired by the time that comes around. What you're trying to do is that firms haven't got to a BAU point of view, and I guess where we come into play is we're able to actually identify the data quality, and I think that links everything together. So it links together to how well regulators are perceived to perform, and so that's why they're on it, and it's the thing that costs our clients the most, because if you don't identify it early, then the cost of fixing it is exponentially higher than it should otherwise be. So if we look at just the base numbers, the last 3 years we've tested 3.6 billion records, and less than 10% of those less than 10% have had no errors on them whatsoever. And that's after 10 years of these regulations being live. Now, there are different types of issues and things, but that data quality issue is still front and centre.
You mentioned matching, the pairing and matching before. Do you know what the stats are on success there?
I don't, but I know that a lot of those figures are based upon firms that do delegated reporting, and if you're not pairing or matching when you're doing delegated reporting, then there's real problems. but if they do match, then that's not really a control, because it's just the two sides of the same trade. But they have improved over time, but it doesn't.
It's about 60%. At least paired.
Yeah. But again, what percentage of those are from delegated reporting? I think quite a high percentage of those. So it's not necessarily a good indication about how accurate things are. So.
Do you try and do anything with that internally, Ron, or do you just leave that? Do you leave that to chance? How does the pairing and matching work for you?
So pairing and matching is very important. Less in the CFD broker, because there's more standardization between the different bridge providers and ways we get data to be able to apply the pairing and matching. Where we're currently seeing it, and probably the biggest question mark is in places like Ireland and Luxembourg, where there are a lot of, the majority of funds are domiciled there, but the asset managers could be in London and Frankfurt. And so now the Ireland and Luxembourg, those are sending questions like, okay, we're seeing high levels of low levels of pairing and matching, and then the funds are suddenly they're having questions about it, and then the conversations with their banks or with their asset managers to figure out exactly what's going on. So I think that's when it comes to pairing and matching, that's the biggest question, and a lot of it is just us as a company, we just try to provide as much information as easy as possible for them to digest and review, in order that when they have their conversations with their banks or liquidity providers, so they can deal with it.
I think just coming in there, I think there's been one of the really beneficial things for our clients in the last 10 years or so is a lot of clients tried to build their own reporting infrastructure, and I was at a bank trying to do that. And lots of banks spent a lot of money in building their own reporting infrastructure that provided limited information back and feedback loop back. And I think, this isn't a plug, but, when you've got firms that are dedicated to building that reporting infrastructure, and then they mutualise that cost across their clients, we definitely see, whether it's IHS or ourselves or other firms, they're getting more feedback loop from that reporting cycle than they would do by using their own thing. And I don't have a vested interest in this. I tried building one, it didn't work, but it is true that feedback loop on real-time reporting or T+1 has been a tick, and as our clients have benefited from it.
Did you want to add anything?
No,
okay.
You said it well.
Did I get it right? Yeah. No.
So, looping around to the banking that you mentioned, Constantinos, are you helping people get bank accounts? Where does the regulation tie in? What do you do?
So there's some sort of tricks of the trade, if you like, that using sort of your FCA or your EU firm as some sort of custodian, or being your overarching sort of major relationship with credit institutions and PSPs to allow for groups to fall under an umbrella. But generally, to be able to bring in and give some, how should I put it, support to your island brokers or even your SISEC broker from time to time, as SISEC brokers struggle just as much depending on the broker, to open banking relationships. Having that regulation and sort of umbrella or custodianship relationship allows you to sort of group it under. But you start looking at a whole host of equivalency issues, going out to G20 countries, looking at anywhere and everywhere that will try and give you a bank account. So G20 countries are seen as equivalent, so you're looking at, people looking at Indonesia now, they're looking at Mexico, South Africa, although you're going to struggle to get your money out of South Africa. And then there's loads of little nuances that come into play.
Jude.
Yeah, I'm same. I'm seeing a lot of the payment services providers, some of the bigger names in the market, they are looking for tripartite arrangements. So, you want to collect funds for your little sunny island jurisdiction. They still want to sign terms with your FCA regulated firm.
Yeah. But what does the FCA say about you taking money? Does it create a misleading perception?
Yeah, well, I mean, funnily enough, I had an email from a client about that yesterday, and I was pretty negative about it. I mean, you certainly can't. You've got to be careful about. You can't. You have to hold client money in a client money account, and you can't pollute that pot with another another entity, regulated or otherwise, with their funds. You can't collect money from their clients into your client money bank account without potentially opening up a whole can of worms.
Ron, did you want to add something about banking, or you're well out of the banking space?
These guys said it well.
Yeah, it's nice not to be involved in the banking too much. Okay, so I was going to throw to the floor if anyone wanted to ask any questions before I do my final wrap-up. Any questions? Go ahead.
Thanks.
Thank you. So, what do you think will happen to social media advertising and the retail FX sector? Does it have to be regulated? Will it be?
This is actually something we... Hello? Yeah. There's been a big push on this actually recently, when the move to sort of gamification comes into play. And then the FCA's sent out sort of consultation papers, I think, or they're starting to send them out, on how you're supposed to monitor and control social media. And things as silly as sort of influencers. So everybody has an influencer on Instagram. How are you monitoring these influencers? Are you providing the material, or are they just giving out random pieces of investment advice to people who are following them and then branding you all over their jet or something like that? Whereas the line of misleading information and so on with these guys come into play. I think it's something we'll see a lot more over the few coming years, especially in how to monitor it. There's already affiliate marketing softwares in play that pick up on different types of marketing to monitor if your name's some random person that's an affiliate and that person has a relationship with another landing page, is branding you on through their page through some aggressive marketing that Prince Harry was trading on crypto and made loads of money, stuff like that. So yeah, we're seeing a lot of that monitoring start to come into play. So looking forward to seeing some advice from sort of FCA, SISEC and ESMA on what the avenues they'd like to see there and how much monitoring that is required.
Yeah, I would agree with that. I mean, the FCA, certainly from the FCA point of view, they've always had a very wide definition. Financial promotion, it's a very wide definition, so they haven't boxed themselves into any form of medium, social media, print media, whatever it is. if you've arranged it, or you're participating, or you've issued it, or you've approved it, or you're benefiting from it, it's a financial promotion. And so yeah, I think that actually the FCA has released guidance in the past about social media, and I think it's always been quite consistent. And they define it as it's an invitation or inducement to engage in investment activity. So it's a very broad definition.
But then I've seen taxis with brokers on them. I've seen receipts with brokers on them. What's the story with that?
The story with that is that's classified as an image advert. So as long as there's no, it's that invitation or inducement. The fact that you've got your brand, you could put your brand, you could put your telephone number, you can put your commission structure. But if you start saying trade with us, or any form of, then you've got to bring in the risk warnings. It's got to be clear, fair, not misleading, and all the other rules kick in at that point. So it doesn't matter if it's on the side of a taxi or on an umbrella. You can't go beyond that kind of very basic image advertising.
And what about the football teams?
Well, firstly, they are. Well, the reason everybody does football teams, because you're not allowed to advertise CFDs on mainstream television. You can advertise it on some of the cable channels, but you can't do it on. So obviously, football advertising has always been a way of getting your name in the frame, basically.
Doesn't it come with a natural health warning? Because some teams do go up and some teams do go down. So, and current form isn't predictive of future form. I say that as a Spurs fan. So,
So you don't see FCA say anything about that. That just goes through.
Well, I think it's image advertising. So it's limited in its scope. It's all about getting the brand in front of the viewer. I don't think they go much further than that. So,
I think where it comes in is more on your positive and negative target market, and that's where the FCA and CISIC have had some concerns. CISIC has actually approached a few brokers that sort of aggressively do it with football teams, and they're saying, how do you say that everybody sat in that stadium is in your positive target market? So MiFID II kicking in with product governance and so on.
Yeah, that was going to be my next question, because Australia's only recently introduced that concept. So I'm interested to hear what FCA and CISIC have done about that target market issue. It seems very abstract on a lot of levels. How do you say something about it?
Yeah, it is quite abstract. I mean, the concept of saying, okay, right, so I can only market now to people who are over 18, have never been bankrupt, are not in a high-risk category, maybe not an elderly person who this sort of product might not be suitable for, and so on. It starts to really clamp down on where you can market, how you can market, and so on. Maybe they're saying, look, everybody can afford a football ticket, so they can afford to trade with us. I don't know. And they're healthy enough to go and stand up and watch
They're
football.
your clients, Constantinos, so what do they say?
Generally, it hasn't been too aggressive yet on that side of stuff. They're still, as Jude has said, it's just a brand. They're not forcing anybody, you're not inviting anybody, you're just getting your brand out there. Which, for Australia-wise, the major one I can think of is eToro right now, who are, all over the Australian rugby team, the NRL. So I wonder how that will affect them in Australia. I look forward to seeing how ASIC will handle it.
We'll talk about that next year. Go ahead, Jude.
I was just going to say, I haven't really seen the FCA push back on football advertising, but they have pushed very hard on appropriateness. So that's the barrier of entry, what are the clients you're actually taking on, and they do expect that target market analysis. They want to see product governance. They want to see a defined target market, but I haven't yet to see them link that to football advertising. Okay,
so Ian, you're headed back a few blocks away. What's on your agenda for the next couple of months?
For us, it's so we're expanding in EU, US, and APAC at the same time. So that's quite a lot to contend with. So in terms of new regulations, we've just gone live with our SEC service and prepping for CFTC right in the States. In Europe, it's really about getting our the art of what's possible to clients that might not have had that previously. And there are a few other bits and pieces that we're working on. So, yeah.
And so if there was someone here who had never done a reconciliation or review of their reports, how would you sell that to them?
Give me a call. No, I mean, we try to keep any kind of persuasion in terms of meetings and chats to a minimum, and we kind of just put our money where our mouth is and says, if you want to have a look at our test results, then we do a free run of our test results, and then you have a real conversation to be had about their results rather than theoretically we do X, Y, and Z. So that's normally how we do it.
With the hope of avoiding a fine.
Yeah, I mean, I think the risk of a fine. Let's not. I think it can be overplayed. So the number of firms that are going to get fined are really small, and you're going to have to be really unlucky. I mean, the FCA have only fined 14, 15 firms under MiFID since 2006. It's not a high hit rate, but it's the biggest driver about getting the reporting correct is the cost it is to you as a firm, and it's that death by 1,000 cuts, which affects large and small firms, and so it's about trying to reduce that as much as possible. That's the real risk that firms have, that their cost of reg reporting, which is already high, can go into multiples if they don't get it right. And it's better to get it done outside of the glare of the regulator. So there are dozens and dozens of firms that are on the naughty step. Very few of those go through to fines. So you want to stop getting on the naughty step and not even worry about the fine, I guess.
Jude, what's keeping you busy?
Mainly implementation of IFPR, so that's the new prudential rules that I referred to earlier, come into force on, I think, January the 4th. Quite a sea change in calculation. Most of the little 125s are going to have to step up their capital. So yeah, a lot of preparation work for that. That is the main.
Ron, you're back to Israel. What's going to keep you busy for the next few months?
So I think if to be honest about it, I think if it's kind of given an item that if you don't take anything away, at least for what I'm saying today, what keeping me busy is what's keeping our clients busy, specifically when companies have employees that left. And this is a big problem that's within the market, and I think it's under-addressed, is you might have, we saw this with Emir, it's got started in 2014, and you might have a developer or a compliance person that set everything up. They left, and then they wanted to make a change, and no one has any idea what's set up. I think this is something that's applicable through, whether it's transaction reporting or KYC. What I say over and over to our clients is like everything in compliance. You can report a certain way, you can have a certain process, but just write it down. So for two reasons: A, if the regulators ever ask you why did you do this, you can say, okay, we had a panel together, we discussed it, and this is our idea behind it. And also, when people leave, there's something for them to review. And I think we're going through, being here in this week in London, I've had a number of these meetings where people are like, okay, I just started the company three months ago. This looks really strange. Like, why are you doing this? I think there's this, it's a not understanding. We're taking data and doing things to it, but they're not even sure why we're doing that. So we have to go define why their predecessor, and it could be the predecessor's predecessor, told us to do certain things. So.
Well, Ron, we really should talk, because we've got a new service that captures all of that online, but we can talk about that another time.
Yeah, I was going to say, how would you write that down? It sounds pretty hard to document.
Yeah,
it's in the FCA handbooks. It has this information of ways to process and record keeping. So,
yeah. The one way to do it is you digitalize the text, and then you allow firms to annotate on the text, and then that's saved. And that then can be linked to policy and control documents and BRDs, and you don't have that institutional amnesia that happens when the legal person with their ring binder leaves the company, because it happens across the street all over.
But I think it's not necessarily there's not tools to do it. Everybody has tools. I mean, I have to write expenses down, and the first day I'll put, I'll itemize everything, and then by the end of the week I'm like going through 4 or 5 days. So I think the problem,
it comes down to usability
I
and
think
direction of the firm.
I think the problem is that people just don't do it, even though the tools exist.
Yeah.
Constantinos, last but not least.
So we're sort of on the other side of what Jude mentioned now. So looking at assisting on the IFPR, there's a lot of recovery plans that need to be submitted in line with the new prudential regulations, and then the FCA is giving out all the landing slots for the TPR, so that's going to be keeping us busy. And then it's coming towards the end of the year, so all your annual reporting obligations, and internal audits and compliance.
Okay. All right. Well, thank you, everyone. We've used up more than our time. We'll all be around for a few more minutes after this, or downstairs if you've got any other questions you'd like to ask. So thanks, Constantinos, Ron, Jude, and Ian.
Thank you, Sophie.
Thank you.
Thank you, Sophie.